And tonight's show, we see if REA's chief economist, Nerida Conisbee, is seeing a house price recovery. There were some doubts at one stage, and she got in a bit of a controversy with another data watching organisation. Be interesting to see what she says now. We find out what a buyer agent, Rich Harvey, does. He comes from propertybuyer.com.au. And it's going to be very interesting to see what he's seeing at the moment and what does the buyer agent actually do. And then we talk to two guys who started a company called M Squared Capital. They lend to property developers, to builders and to businesses that are looking for investment funds, and they are for sophisticated investors, but their story is a very, very interesting one. That's the show for tonight. Without any further ado, let's go to Nerida Conisbee from REA. Well, controversies over whether the house price rebound is as big as we think is still out there in the property debating sector. And joining us now is Nerida Conisbee, the chief economist at REA. Thanks for coming on, Nerida.
Thanks for having me.
Now, last time we talked, you caused a bit of a controversy, not necessarily agreeing wholeheartedly with what you've seen. Has your view changed in recent weeks or months?
Yeah, I mean, we're continuing to see a recovery, and you know, we could always clearly see that it was on the horizon. We're still seeing not as strong a swing as what CoreLogic is seeing, and I think this is fundamental. Obviously we're looking very closely at our model to see why CoreLogic swings so far down and so far up, and ours is a lot flatter, comparably flatter. And you know, we looked at our data feed, and you know, our data's looking fine. And we fundamentally, I mean, we're no longer selling data to CoreLogic, but we fundamentally don't think we do have data sets that are different enough to explain the differences. I think what's happening is related to the model, and I think one of the things that people don't always understand is that an index is modelled, and so you do rely on, firstly, the model that you use. There's a lot of assumptions that you need to make around data and what how you categorise certain property types. And so what I think might be happening is that our model is just categorising things differently. Our model, we update it when we get new data, and we don't, I mean, we're not sure exactly what CoreLogic are doing, but we don't think that they update it when new data comes in, but you know, perhaps we're wrong. So, I mean, we're continuing to look at it. We're doing a deeper dive in January. We are planning to launch it in around March, by which stage, you know, we will have had a thorough review as to what's going on. I mean, at the moment, what we are seeing, you know, firmly Sydney in recovery. We can see that price growth in Northern Beaches, for example, is roaring ahead, and we've got the inner east doing incredibly well. And
that's the point you made, that you saw that some suburbs weren't really reacting at all, and so it wasn't an even spread.
Yeah, and look, it's still, pretty much everywhere is recovering in Sydney, but if you compare Parramatta Apartments to eastern suburbs, you know, you're getting vastly different price growth. Southwest Sydney is performing very, very different to the Northern Beaches. So, you know, we're still seeing this differential. Again, I suppose when we launched the index, we kind of didn't necessarily we didn't think it would cause so much outrage. We're quite
this
surprised.
Is a very controversial sector of the economy.
I know. We basically, you know, we developed an index with, our home track data science team developed an index. We had it audited by the Deloitte data science team. So, you know, they went through it in a lot of detail and gave it the tick. And, you know, we saw this. I mean, actually, it was funny too, because coming last year when, you know, when CoreLogic's index, you know, the same way it's kind of shooting up now, it was tumbling down very, very fast. We weren't seeing that, but, you know, and I was saying, I don't think it's as bad as what CoreLogic is saying, but then, of course, no one believed me because I'm from a property company.
Yeah, of course,
And so I was kind of seen as biased, and now it's shooting back up, and we're going, yeah, for sure, there's definitely a recovery. There's no doubting it, and it's just the scale at which we're seeing it versus CoreLogic.
And look, you make the point, and some people watching this may not be economists. I'd say that would be probably most people watching this. And when you create a model, you put certain weightings on the things that you're looking at. when I taught economics, it was marginal response coefficients, but I would never use a word like that with normal people watching. But what we would do is we'd value some things were more important than others. Like, for example, interest rates were more important than, say, the weather. And so you'd have higher values. Now, when you guys start constructing your index, you might not have exactly the same weightings on various suburbs, and therefore that could explain partly the reason why your prices aren't jumping up as fast.
Yeah, potentially. I mean, and also when we have a look, I mean, we've obviously had a look at the models that everyone's using. So we've looked at CoreLogic's model. Yeah, we can't look at their model, obviously.
No,
but we can look
private.
at the method.
It's right. It's intellectual property. Yeah.
Of course, but we've looked at their methodology. No, I mean, we've looked at the type of model it is. We've looked at the ABS model, and that's a different model, and then we're using a different model. So, on one hand, we're not showing lots of swinging around in terms of pricing. CoreLogic is, so maybe it's somewhere in between. I'm not sure.
Okay. There's been talk of quantitative easing. 2 questions. Do you think they'll do it? And secondly, if they do, what do you think it would do to house prices?
Look, at this stage, I'd say no. Yeah. And anyone who is predicting for sure that it's going to happen is probably more of a fortune teller rather than an economist.
Yeah.
I mean,
a doomsday fortune teller.
The thing is, things are changing so rapidly. I mean, Brexit, for example, is something that a month ago was looking like it would never be sorted out, and we are getting closer to a resolution. The US-China trade issues, again, every day there is some different story as to what's happening. So that creates a little bit of that creates a lot of uncertainty. I suppose at the moment, if you have a look what the Reserve Bank is saying, when they're saying turning a gentle corner. You had Ian Harper in the Oz this morning saying the same thing. I mean, he's on the Reserve Bank board, so he's
yeah, but he's independent still. I know. He's a curmudgeonly so he wouldn't agree just because he was on the board.
No, I don't think so either. Yeah. He's an independent thinker. So, so I think we're not seeing. I mean, we are seeing house prices increase rapidly, but on other measures, we're not seeing it moving as quickly, but monetary policy does take time to work. I mean, you can't cut rates at the start of a month and expect it by 2 weeks later that everything's moving forward.
We used to teach 6 to 12 months before it really kicked in. Look, I would say probably one of the big positives of the market is the fact that house prices are coming back, and that can help the economy as well. Do you think they'll cut in February? I know it's a guess, but what's your best guess?
I think quite possibly.
Yeah,
I think it is looking more like the bank economists are all saying it can't, and they look at things in a lot of depth. So from the data points that we know are important, obviously inflation is a big one, and wages growth and GDP growth. It's looking flat enough to suggest another cut. Whether the issue of quantitative easing, though, I just don't think at this stage we will be moving towards that.
No, but I certainly agree with you that, and I'm an optimist, you know that. I was hoping that the tax cuts and the rate cuts would have started to show, but they might show come March or April, and then Josh Frydenberg won't have to do an extra tax cut. But if we don't see anything by April, I think I'd be penciling some tax cuts in the budget.
Yeah, I think so. It will be a more interesting budget. I was in the budget lockup this year, and at the time, I think most people were expecting an ALP win. So it was a pretty low-key budget. Yeah. But I think this next year will be more exciting.
Okay. Overseas investors, any sign that they're coming back? And I bet you say yes, and they're from Hong Kong.
They're from Hong Kong. They're from Hong Kong.
Why wouldn't you if you're living in Hong Kong?
Yeah, Hong Kong has surged. Yeah. I mean, we can see search jumping, but we can also see, we obviously talk to developers a lot. They're our major customers, and a lot of them are doing offshore marketing campaigns over there. So, well and truly, Hong Kong. We started to see last month. We did start to see a bit of a pickup in other Asian investors looking at Australia.
Yeah.
So
I guess a lower dollar helps there as well, doesn't it?
Yeah, lower dollar. And I think heat coming back into the market. I mean, you've got to, if you have a look at, say, Chinese buyers, a lot of them, they're not inactive. They're in Malaysia and Thailand and Japan at the moment, but they're not in Australia. So I think, the recovery that we're seeing in the market is really making a difference.
Now, one thing you did say earlier, and I wanted to pick up on it, you said, well, apartments in Parramatta are not doing as well as those in eastern suburbs. Is the Parramatta effect linked to the Homebush structural problem with apartments thing? if you can get
the Opal Tower.
yeah, if I was buying an apartment now, even off the plan, I want a low-level apartment complex. I want it to be expensive, and I want it to be a really well-known and great builder. If it was something like a relatively unknown builder, it was a really tall tower, that would worry me. If I was just in that buying market. Do you think that's playing on the minds of some people that the bigger they are, the more likely they might fall over?
For sure.
Yeah.
I do think investors are quite worried about it. I think the quality issues are more apparent in Sydney than we're seeing elsewhere. Melbourne does have flammable cladding issues, but Sydney does seem to have more problems with quality. I think Parramatta. One way we can really see that there is a problem of oversupply there is when we have a look at rental demand and views per listing in Parramatta. Every rental listing we've got in Parramatta at the moment is seeing around 900 views, which sounds a lot, but it isn't a lot. And it's actually the same as what we're seeing in Darwin at the moment. So the Darwin property market is in trouble. It is in big trouble. There's really nothing positive to say about it. But Parramatta is seeing quite similar metrics, and so it'll be okay. Sydney's growing. There's a lot of investment in Parramatta. There's going to be a fast rail.
It sounds like a buying opportunity, really, given that that Parramatta does have economically has a lot of things going on there.
Yeah.
That's not a tip, by the way. It's not advice. We're not giving advice.
No,
it's
we're
just
not giving advice.
Educational observation. Yeah. Okay. One last one. If someone said to you, well, Nerida, you're the expert from REA, what would be your investment strategy for 2020?
Sydney, Melbourne are recovering. I think they're the markets where we will see the most price growth. So, and then long term, that's with property you do need to hold. So if you do better if you hold for long periods of time. So, in a Sydney, in a Melbourne, getting more specific, we're starting to see a lot of activity going from Byron up to Southern Gold Coast. I think that strip is
Don't tell
starting
people. I don't want people going there.
No,
I'm looking at a place
in Byron.
We're in Cabarita.
Cabarita, yes,
nice. It's nice, but it's cheaper. And it's close to the Gold Coast Airport. Why am I telling people this? I'm killing the...
Have you got a development?
No, I haven't. I should have. Anyway, but how about Brisbane and Perth? Because people have been waiting for both those. Perth's really struggled. Brisbane hasn't been doing much. Are they still looking as though they're on the improve?
Look, I think Brisbane's a very steady market. I like Gold Coast better than Brisbane. I think Gold Coast, we know Gold Coast has a land supply problem. So there will be less land available to do houses. So a house on the Gold Coast, I think, would actually do quite well long term, provided they don't release tons of extra land, which doesn't look like at this stage.
And closer to the beach, but
closer
not too close
also,
in case climate change gets you.
It's true. When we're looking at search from Sydney, we can see a really strong push up to Gold Coast. So it does seem to be a key beneficiary. So I don't know, I like Gold Coast. Brisbane's fine, it's pretty steady, and the oversupply issues have washed through, and it's, if you wanted a steady market, it would be pretty good. Perth is highly, it's a bit like Sydney at the moment, that we are seeing inner Perth starting to do, it's been doing exceptionally well for quite some time. So, if you buy somewhere like Subiaco or Shenton Park or City Beach or, or City, I'm trying to think of all the other beachside suburbs.
Cottesloe
that's what I was trying to think of. So Cottesloe, they're doing really well, but if you wanted to buy fringe in Perth, I think it'll be struggling. Yeah, it's so extreme that the amount of activity we're seeing in inner Perth is actually 3 times more than what we're seeing in the middle and outer suburbs. So it's quite different.
Nerida, thanks very much. Have a great Christmas.
You too.
That's Nerida Conisbee from REA. Well, at a time when the property market is on the way up, or that's what most people think, I thought it'd be a good idea to talk to someone who's actually at the coalface, helping a lot of people buy homes. His name is Rich Harvey, and he comes from a business called propertybuyer.com.au. Rich, thanks for joining us.
Great to be with you, Peter.
Let's start off for those people who don't really know what a buyer agent does. What do you do?
A buyer's agent is very different to a selling agent. A buyer agent only represents the buyer in the transaction. They work exclusively for them. They help them find the property, appraise the value, and negotiate the property for them. So they're their advocate. They're on their side and they're helping them through that whole buyer journey. But the key distinction is they're paid by the buyer, not by the seller.
Right, and so I guess most people will think, well, how much do you pay for someone like you to do it? And then we're going to ask what you actually do to justify the money.
Yeah. Well, what do? We follow a 7-step process. So if someone comes to us and they want to buy a 4-bedroom house in the eastern suburbs, we'd get a brief from that client. We'd give them some research and some suburb profiles, all the stats, the median prices, recent sales. Then we start the searching process. So then we find a property, we appraise it, we evaluate it very, very carefully, very accurately, and then we negotiate the best price we can for that client.
Yeah. And so what kind of price would they pay you to do that work?
So the fee, it's a fixed fee. I decided very early on in my career to make it a fixed fee. So under $1 million is the equivalent of 2%. Once you get over the $1 million mark, it's a sliding scale. So by the time you get to around $2 million, it's the equivalent of 1.5%. But the key point is it's a fixed fee per price band because I don't want there to be any bias in the way that we negotiate.
Okay. And I guess a lot of people then think, well, okay, if I'm going to pay that to Rich, he has to be able to prove to me not only can he find great places, but he also get a better price.
Justified. Yeah.
So how do you actually pull that double play off?
Well, I guess the value proposition, if you like, I mean, that's what you're really asking. It's not just about the price and the fee. There's a couple of other factors. I mean, you've seen the market's gone crazy. The rebound has been so strong. We're getting so many frustrated buyers coming to us. So a couple of things.
So you're answering my question.
Oh, is it?
Already,
oh,
okay.
Okay. But no, but it's
okay.
But I guess the value is, look, we can find properties a lot faster. So it's a huge time saving. That's one of the key things. It's the time. So it's not just that. Yes, we negotiate. Sometimes we can negotiate a far better price, but it's also putting the buyer to the front of the queue. You know, when you've got 10 bidders at an auction or 10 or 15 people all vying for the same property, we advise the client when to walk away and when to make the next bid. And it's really having that confidant on your side that makes a huge difference.
So you actually turn up to the auction?
Absolutely, yeah.
I guess a lot of people would be wondering, do real estate agents call you when they've got properties?
Absolutely.
Yeah.
Well, that's one of the key things. One of our key things that we bring a lot of value to the table is off-market properties. So we get access to pre-listings, properties that will never hit the market. And there's a couple of reasons the vendors might want to sell off-market. One, they don't want to pay marketing fees, so it's cheaper for the vendor. Another one is no auction fees, etc. They don't want people traipsing through their home twice a week at open for home inspections, and they don't have to style the property. They can just get it as it is and sell it as it is. So, but I reckon a key factor with off-markets is there's less competition. So for our buyers, it means we can bring them through. We're not trying to pinch the property. We want to pay fair price for it, or the lowest we can, but a fair price. And it's great for the agent because they can tick over a few more transactions, and it's a great seamless transaction for everyone.
And I guess you get the sort of properties which wouldn't necessarily do well at auction, and people need to be able to sort of have a special feel or connection to it.
It's not necessarily a special feel to them. Some of the owners of these properties might be celebrities or politicians. I mean, we've bought a number of those properties for our clients through off-market agents. But it can be actually for anyone. Any of those properties could suit our clients.
Okay, so let's go and talk about anything that you think, when people come to you as a client for the first time, what do you surprise them in a sense that they didn't expect that you would do that, but you do it?
Yeah, great question. A lot of our service is intangible. So a lot of people go, I'm not really sure if you can find me the property. Can you guarantee to find me the property I want? So let me give you an example. I took on a client the other week. They wanted to buy one of the best type of properties in a particular suburb on the northern beaches. Now, I showed them what I call best in show. They had a budget of up to $3.5 million. So I showed them all of the properties that I could possibly find, mostly off market, and they still said, Rich, it's not good enough. So I said, that's fine. I said, let's look at knockdown rebuilds. So I then had to find a block that was over 1,000 square metres in a suburb that has very few properties like that. So we did a letterbox drop. We actually found a vendor, and we found this great property, and we negotiated a price just sub 2 million. So I got it for well under their budget. They're going to spend $1 million, 1.2 on the build, and they get exactly what they want with a district, bush view, quiet street. It ticked all the. And now they said to me, Rich, we could never have found this property without you. So that's just one example. But
and it's expertise.
It's the expertise. It's just knowing that local market and knowing what to pay.
And some people are obviously too busy to do the research that maybe a really anal, retentive person probably could do and get close to at least finding the properties that you guys Well, probably we get the off-market ones, but they get the on-market ones.
Absolutely, yeah. I think your point about sort of the annual retentives, I mean, you're an economist, I've been an economist in my past life, and so I remember when I got to buy my first property, I was way too analytical, and I deal with other analytical types, and I know their thinking, and I think people get stuck in this paralysis of analysis situation. So some people would actually never buy a property unless we guided them through.
Yeah, okay. So let's talk about the market now. I was going to ask you a question. We've had conflicting views from various data watching groups. CoreLogic seem to be telling us that the house prices are rebounding. What are you saying?
Absolutely. I mean, when ScoMo got back into government, it probably took around a month to 2 months till confidence in the property market was fully restored and people realised, hey, negative gearing's here to stay. APRA dialed down some of the lending restrictions, and then our phone started ringing hot, and it's pretty much stayed that way right through to early December. So we are definitely seeing a strong depth of buyers, and I think one of the critical factors that's been driving the market the last 6 months is the shortage of listings. So there's been pent-up demand, listings down by 19 to 20%, and lots of buyers starting to get that, unfortunately, FOMO disease again. Like I go to a lot of auctions, and you know, there's 10 to 11 bidders all paying some stupid prices, and I just say to my client, no, we're not going to buy this one. And in fact, I've transacted 3 or 4 properties last month, and we've got them for fair prices, even in a crazy market. So the market is definitely rebounding.
But I guess at times you're going to have to deal with a cranky client as well, that you're saying don't buy, but they had that kind of passion for the property. How do you manage that?
Well, it's about dealing with emotions and expectations, Peter. I think we go back to basics and we say to the client, what was your brief? You told me your budget was 1.5 and not a cent over. Look, and I'll be honest with you, if we can't achieve the brief, I won't take them on. So we just say to the client, for example, another client in the inner west, they had a budget of 1.5 and we kept missing out. We missed out 4 times at auction, and they were just you'd see their faces. We go to auction and I would just look, I say, no, we just wear out. And I'd say to them, just be patient, the right one will come. And just the other week, transacted a property. It was on market. It was best and final offer by 4 p.m. Monday, and I made the winning bid and got the property for them. And they were just elated, you know. So finally, this weight's lifted off their shoulders when they get there. So it's really going through that emotional roller coaster with them and keeping a positive attitude all the way through.
Are we seeing listings starting to increase? I would have thought the headlines about higher prices should help all those people who were disappointed 2 years ago and probably rented their property out or something like that. These people would be now thinking about adding to supply.
Well, I'm surprised that vendors have been very slow to respond to a rising market.
Too.
I think that we're talking to a lot of agents. They're saying, I've got 10 listings coming on late January for Feb. So I've got 15 listings. So I'm going, fantastic, bring it on. I think there will be quite a rapid start to 2020. And I think once we see listing volumes get back to sort of normality and not the sub 20% listing levels we've had, price pressure will start to moderate. I don't think price growth will stop next year. I'm going with Louis Christopher's estimations of a 10 to 15% rise in the blue chip areas next year. But I do think that sort of really hot pressure market will start to abate probably at about sort of April, May next year.
Okay. So if you had to give anyone a tip in the current market who's continually being frustrated by not getting what they want, what would you suggest?
A couple of things. 1, use a buyer's agent, number 1. 2, just keep doing your research. Look, as the year goes on, some people are really fixated on one suburb. And they just go, I just want to buy in this suburb. And they're already priced out. And the problem is they end up going to buy on a main road or next to a petrol station or something that's a really substandard property just because they want that suburb. I'd say to them, cast your net further afield. Let's look at the adjoining suburbs. Let's look at a rail line or a bus line route that's only 2 suburbs away, that's not too far from the schools and the transport, whatever the connections you need. So think about slightly compromising your standards.
I must admit, in my real estate buying career, going to the next suburb of a really hot suburb has been a really good way of making money.
It's the ripple effect, isn't it? It's absolutely, like if you're priced out of one suburb, go to the next one, and that growth wave will come because there's going to be a depth of buyers behind you that all have that same thought pattern as well.
Great stuff. And one final one, do you suspect that we're going to see prices rise this year, to 2020, but then stabilise or go up again?
I think next year we'll continue to see that the first sort of 2 quarters of next year, as I was saying, I think we're going to continue to see all of those frustrated buyers are still in the market wanting to buy. So if there's not enough listings, that will definitely put price pressure on. But I also think the other thing, Peter, the developers that are out there, we work with developers to find sites, and in talking to them, they haven't been transacting on many sites. And if you listen to the old mate at the Reserve Bank predicting there's going to be potentially an undersupply, we're seeing supply absorbed already in those areas. And the time it takes from a developer to go, hey, let's put up 100 units here, to the time they deliver those units is a long cycle. It could be 2 to 2.5 years. So I think we're going to have strong price growth in the first half of the year, and then more moderate price growth, probably 5% per annum thereafter.
Okay, one last thing, you bring up the apartments and the development issue. Have you found a lot of buyers wary about buying apartments because of the cladding and the structural building problems?
There's like a buyer strike, if you like, for off the plan. People are just, it's on the nose at the moment, unfortunately, because there's some really good quality developers out there that build great stock, like a Mervac, that really build good quality stock. So those developers are having to think about a different marketing campaign. They have to nurture the buyers and show, hey, these are the products, the safe products we're building with. We don't have a track record of a lot of litany of defect periods afterwards, and it's kind of a re-education of a lot of those off-the-plan buyers.
So do you help people buy off the plan?
We do. I've used it myself many times, quite successfully, but we're very, very selective. I mean, the majority, probably 98% of what we buy for clients is established property. The other 2% is brand new, where we help foreign buyers or someone that wants to buy into a new development. Maybe it's a first home buyer buying something.
So if you're going to do off the plan, and I know people like you have reservations about doing it in a general sense, it has to be a top quality developer.
100%. So you've got to do a lot of due diligence, not just on the developer, but the builder who's doing that development, and make sure, and also get a great property lawyer to check the contract. I mean, new laws around sunset clauses, but there's a lot of extra checks and balances you have to do.
And do you make sure that they have a good lawyer?
Absolutely. We refer them to a great mortgage broker, a great financial planner, and a lawyer to make sure they've got all the right steps in the process.
Okay, mate. Thanks for joining us.
Thanks, Peter.
That's Rich Harvey from propertybuyer.com.au. Guys, thanks for joining us.
Thank you, Peter.
All right, so I think before we start, people would like to know, what is M Squared Capital?
M Squared Capital is a non-bank lender. We match high quality borrowers that are looking for finance, either to refinance or commercial, residential, industrial property, with investors that have got money that want to lend their money.
So in a sense, you operate like a market. You've got people who want to do buildings of some kind, and you've got people who want to lend money to those sorts of people.
Exactly. I mean, the thing that we also do, which I think is important to understand, is we don't just lend to developers. We lend to properties along the eastern seaboard and that are existing. That's our core of what we lend towards. But it is peer-to-peer lending, and we match investors.
Now, a lot of people don't understand peer-to-peer lending. So let's ask Paul Mirren. Paul, what is peer-to-peer lending?
Well, peer-to-peer is basically you have an investor who has a particular requirement and you have a borrower who has a requirement as
so
well.
it's people to people.
Absolutely. So it's
why don't they use peer? Right? It instantly makes it harder for people to understand. So it's people to people investing, lending and borrowing. All right. So Paul made the point that it's often existing buildings. So are we doing massive renovations?
What we're seeing in the market at the moment, where our niches are, is when we're looking at a block of units, for argument's sake, Peter, the banks are lending the people that have constructed these units a pretty conservative amount. So they might be lending them 50% of the value of that block of units. Where we're finding a good niche is lending those completed stock developments up to say 60 or 65% of that value. And typically the people that have built those developments are selling them down. But there's no construction risk. They are there and they're existing.
So you're lending to the potential buyers of these properties or to the actual builders themselves, the builders/developers?
We can do either, but typically where we're finding the niche is with the person that's actually developed the stock.
Okay. Now, and explain again why that person might need to get more money. They've already got money from the banks, and they've done pre-sales in some cases.
Correct.
And so are you saying sometimes along the way they might need an extra $3 or $4 million to complete it perfectly, and the bank's not going to give them any more, and they haven't enough pre-sales, so they go to a group like you?
Well, it's not necessarily that situation. Is normally you have a construction lender giving them finance for a specific purpose.
Yeah.
Once the project is finished,
Yeah.
there's a requirement to have a refinance done so to allow for a sale. So predominantly a bank policy would be is to say that, okay, we're happy to lend you the money for the block of apartments that you have left over, or the security that you have left over. We would like you to actually rent them out. So for the developer, in that instance, it's not very favourable because the minute he rents it out, it's harder for him to sell.
Yeah.
And there's that brand new finish
Yeah, okay.
is not necessarily there, so the price goes down.
So in simple terms then, there might be 50 apartments to the block, there might be 10 left over.
Precisely.
And the banks could say, well, you rent them out, but they would prefer to try and sell them. But, and so you guys come along and say, well, we'll bankroll you for those 10, and when you sell them, you can pay us back and so on and so forth.
Precisely.
If it takes you a year, you guys get a year's worth of interest.
Correct.
Okay.
The more important part of that is that it's a structured facility. So it's structured to exactly what the borrower requires. And so that's what we come in. We find gaps in the market or niches that are not being fulfilled.
And is it better for you because at least in most cases they're finished? And so rather than sort of keep my fingers crossed, will the developer actually complete? What you're gambling on is can he sell the properties?
Precisely.
Okay.
And so we do a very strong due diligence in relation to the demand supply of that particular area.
Yeah.
We will take a position of an understanding of how long it would normally take that particular developer to sell down the property as well.
Yeah.
And so we make sure that the terms of the facility enables them to do it as well.
Okay, so 2 years ago, you might have had a few anxious moments when prices were falling and people weren't buying. Since the election and since interest rate cuts, you guys have stopped losing hair. In fact, you haven't lost any.
I'm going grey.
Okay,
Yeah.
so but there's the
Absolutely.
sense can be the
Absolutely.
challenges.
And look, in any type of market, you structure the facility what you think would be the best as well. So if you lend to a very competent borrower who has a good understanding, good track record, they'll make the right decision, and you can work with them to actually make it work.
Yeah, and the fact that banks, because of APRA, were playing hardball on lots of good quality borrowers,
That's right.
I guess that created opportunities for you guys.
Absolutely. Like we're dumbfounded by the quality of the deals that we're seeing now.
Yeah.
That historically the banks would have jumped at.
Yeah.
So the opportunity for us is great because we've got great quality borrowers not taking construction risk,
Yeah.
and that's what our investors are telling us they're loving.
Yeah, but we have to be fair. This is not a term deposit, so it's more risky. So what kind of borrowing rates are the builders / developers paying to you?
Yeah.
And what if someone decides to, roll the dice with you guys? What are they getting? What kind
I'll give you an example. I'll give you an
numbers?
example. Like in the recent past, we've been charging around 9% to the developer builder.
Yeah.
And we've been giving our investors net 7.5% to them.
Geez, so you're only making a pretty small
We're
margin.
doing, look, we can run pretty lean. And
Charitable business, charitable non-bank lenders.
yeah, I mean, look, the reality is as well, in terms of it, you drawing the comparison to a term deposit, I think it's important just to touch on that.
Yeah.
We've done our analysis and we got actually BIS Shrapnel to look at it.
Yeah.
And in Sydney, the biggest peak to trough drop of a residential market was about 18% the last 2 years, mind you. So when we're lending in this situation and giving our investors net 7.5, we're typically not giving the borrower more than 65% of the value of that actual asset. So we stress tested it, and even when it dropped the most it has historically, of say 20%, our investors would have got their money back in full with their interest, which I think is important to know.
So, from your point of view, then, your environment for lending and paying people back is going to be improved if the Aussie economy improves.
Absolutely.
Now, I know you guys are an economist, and I've got my view on the economy, but you also would be taking views from like BIS Shrapnel or BIS Oxford Economics, they call themselves nowadays.
Yeah.
Are they giving you guys confidence that the next year or two is okay?
Look, in 2016, I think it was testament. We saw a little bit of a toppy market. We look in our business. We are lucky that we have got the opportunity for our investors to choose what type of risk profile they want. Yeah. In 2016, we were doing MES finance. So our investors.
MES finance. MES people watching.
Sorry. It's not a first mortgage position, but a second mortgage position. Let's say. A little bit higher on the risk curve than than what we've discussed at the 65% first mortgage market. as soon as we saw the toppy market, so we thought it was particularly in the eastern seaboard at the higher level, we decided as a business to get out completely of that higher risk style lending.
Yep.
As I've said before, it dropped 20% in that period of time. Now we are a little bit more bullish with the market. We do see it tipping up. So we are seeing some really quality second mortgages. And some of our investors who really love that risk can take that. So we have changed the type of deals that we are putting up to our investors. But we do see it a little bit, particularly the Eastern Seaboard, that we are lending in.
So are you saying that some of your deals are less risky than others, and therefore you will pay a lower interest rate?
Absolutely.
And as you go up the risk curve with your borrower,
Yeah.
therefore the lender, the people who come to you, they get a slightly higher.
Yeah.
Absolutely. I mean, I think it's important that you're transparent on what the type of deals that you're seeing.
Yeah.
So we've got a similar philosophy that if
Like
you don't...
because you're both accountants?
Maybe, maybe. It does put us on the more conservative side.
It's like the bland leading the bland,
Yeah.
isn't it?
Thank you,
Well,
Peter.
I
Well, I'm
had
an
a-
economist, I've got to pick on accountants, you know that. Yeah.
But interesting part is that we have a lot of investors who have a very big appetite for higher risk transactions.
It's
And we
amazing,
have-
isn't it?
and that they want to have that exposure because they like the returns. And we have a lot of investors who want a lower risk as well. So what we have, our structure, which is a contributory fund, is allowing investors to choose the type of risk profile of deal that they want to have, which is really important. Not only that, is that we have, the whole reason we started this business is that we believe that if you invest into a mortgage, you need to be able to see what's underneath the bonnet. So all the difficult questions that you ask the borrower in relation to who they are, what's the security, what's their competency, what is their cash flow, all that research or that analysis is given to our investors. And they can make their own decision in relation to that transaction, which makes it quite excited, well, we're quite excited that we're able to deliver that to our investors.
Okay. And what's the minimum amount someone can invest with you guys?
It's $100,000.
Okay.
And
Does that mean that they have to be sophisticated investors?
yes, that's correct.
Okay. It means they're not
Wholesale.
protected by the Consumer Credit Act, but because they're sophisticated, therefore, okay.
Yep.
So guys, you know, I've asked you the questions I would ask if I didn't know much about you. Is there anything else we should know?
Yes, I think there is, Peter. When you're investing in something, Paul mentioned before, you need to understand exactly what you're investing in. M Squared Capital is a simple philosophy. We lend money against Eastern Seaboard properties only. We don't do anything specialised. It's very vanilla. We are on the conservative side of the risk profile, but the difference with us with a lot of other people is that if you want to see the whole due diligence of a deal, and you actually want to see and go into the nitty-gritty of why we're actually doing a deal, we will give you all that information on request.
Okay, so if an investor was going in and you're lending money to a development in Bondi Junction, for example, that person could actually go and do their own due diligence on it.
We would give
get their accountant or their advisor to look at
Absolutely,
it.
but we would give you our whole due diligence pack, which would have the valuation we conducted on the property, the due diligence on the actual borrower, our commentary, our internal commentary notes on why we would do the deal. And we actually risk rate things. So we've got a kind of a risk rating model where we'll have green for the lowest risk, we'll have orange for medium risk, and we'll have red when you're up the yield curve. Our investors are telling us they like that because the green people that want the lower risk, they'll see our green light come via email and they'll look at it. If they see the red light, they say, well, that's not the risk for us.
Yeah. Okay. So just explain to us what you do with the due diligence.
Okay, so the due diligence pack has all those critical questions that we discussed previously in relation to who the borrower is, what is the security, what's the purpose of the funds, what's the cash flow of the borrower, how strong is it. So all those elements collectively allow us to actually give it a risk rating and a risk assessment of the entire transaction. What we find is a lot of people judge a particular transaction on one or two elements, but I think it's more comprehensive to look at all the elements to understand whether you should be investing in the transaction.
And so you're effectively showing the potential lender all the stuff that you went through before you said, yes, we'll lend to this person.
Precisely it.
Okay, right. Now, one other thing, you said earlier that you just don't lend for property or buildings. What else do you guys lend for?
Look, only 10% of our business is lent to property developers in a construction format. We only do lend to property on the eastern seaboard of Australia. So we're not a fund that does weird and wonderful things. We do what we love, which is property.
Yep.
But we do lend to people that are looking to buy industrial property, to buy a commercial property, and that want a little bit more flexibility than the banks are.
Yeah.
So I think the misnomer that non-bank lenders like M Squared are lending only to property developers and you've got construction risk is not right.
Yeah, okay. So, and because you're accountants, you basically would look at any business proposition and assess it.
Sure.
You know, what's the likelihood the person's going to pay back?
Absolutely.
What can we charge them?
Right,
And therefore, what can we pay the investors that come on board to
Exactly. As
support?
long as, and look, the property, the actual security or the collateral that we are taking is a very important aspect of what we're doing, because we only do collateral lending, we don't lend to businesses.
Yeah.
But a story about why he didn't make as much money last year and he's making more money this year will take a bit of a different view than what the banks will.
Yeah, okay. And so once again, an investor will be able to look at the due diligence on that particular business line as
Precisely.
well.
We'll give them all the cash flow
Okay.
so that they can see how the guy's actually going to repay the loan that's secured by the property.
That's Paul Miliotis and Paul Mirren from M Squared Capital. Well, that's the show for tonight. I hope you enjoyed it. This is our last one for this year. We come back on January 20, or the week of January 20, and we'll see you then. Have a great Christmas, and thanks for joining us over the course of 2019.